What if I told you a low-profile company sitting quietly in the background of the financial world might actually be a hidden gem? At Insightful Value, we're not chasing hype. We're digging deep into overlooked companies with serious long-term potential. Today, we're taking a closer look at CAS Information Systems, a small cap that's flown under the radar and whose stock is trading at depressed levels. This video is for informational and educational purposes only. It's not financial advice. If you appreciate unbiased breakdowns of companies that might be worth a second look, make sure to like this video and subscribe to our channel. Now, CAS Information Systems is essentially a niche fintech player. The company provides payment processing and information services to enterprises across the U.S. Its core business revolves around managing and auditing complex accounts payable, including freight and utility invoice management. That means CAS helps companies get their bills paid efficiently, and it makes money from both service fees and interest income on float balances. CAS also operates a small but well-regarded bank, CAS Commercial Bank, which enhances its financial flexibility and revenue streams. So what's going on with the stock? After peaking in 2021, it's been drifting lower. The recent pressure comes from lower interest income as rates plateau, and a generally cautious sentiment around small-cap financials. But from a value perspective, this is where things get interesting. The company has zero debt, strong cash flows, and consistently earns healthy returns on equity. It's not flashy, but it's reliable. In the latest quarterly earnings, CAS posted around $48 million in revenue and roughly $7 million in net income, with operating margins staying comfortably above 10%. The company has a rock-solid balance sheet and a management team that's cautious, conservative, and clearly focused on long-term stability. And that brings us to dividends. CAS has raised its dividend every year for the past 11 years. It currently yields about 3%, which is solid for a company with no debt and a low payout ratio. It's also been buying back shares, slowly but steadily. So why might now be a good time to pay attention? The valuation is at a multi-year low, even though the business remains fundamentally sound. If interest rates remain elevated longer than expected, CAS benefits. If rates drop, but business activity rebounds, they also win. It's a hedge in a very niche financial niche. But of course, there are risks. CAS is exposed to macroeconomic trends, especially in logistics and energy, two sectors it serves heavily. If freight volumes stay weak or corporate utility spending softens, revenue could stagnate. Also, being a small cap with limited analyst coverage means it doesn't get much institutional love, which can hurt short-term momentum. Still, the long-term track record and dividend growth make it worth a look. At Insightful Value, we focus on this kind of overlooked opportunity. We provide in-depth analysis of undervalued companies, breaking down the numbers and business models without the financial jargon. Whether you're just starting out or managing your own portfolio, we help you think smarter about stocks. For more on CAS and other undervalued ideas, head over to insightfulvalue.com and don't forget to like, subscribe, and turn on notifications so you don't miss our next stock breakdown.